Good afternoon, everyone. If you're on the East Coast, and good morning if you're not. If you're on the West Coast, welcome to this TradeStation webinar. We're excited to have you, and thank you for taking time out of your schedules to be here with all of us. We have a guest speaker today. His name is Brandon Wendell. We're going to get to him in just a moment. But before we pass the microphone over to him, let's go over some introductions and also some disclosures. The title of today's presentation is Bear Call Spreads, Trading Time, and Volatility. And as I said before, this topic is going to be presented by Brandon Wendell. He's a trader and a trading mentor and have a lot of expertise trading options, and I'm very glad to have him here. My name is Jesus Nava. I'm the Director of Client Training and Education for TradeStation Securities. And my goal here is to make sure that the TradeStation platforms are something that you're comfortable with, and also, bring topics like this just to help you in your everyday trading. For every symbol and idea that we talk about, I want everyone to remember that these are examples, that they are not recommendations of TradeStation. Also, that active trading is not suitable for everyone, especially when it comes to trading options, which carry a higher degree of risk. Past historical performance is no guarantee of future results. We are going to look at certain examples that do provide certain performance measures. I want to make sure that everyone here is aware that that's not a guarantee of future results. Also, that Brandon Wendell is not affiliated with TradeStation, and his ideas and comments are going to be his own. So thank you guys for being here. If you need any more information on these disclosures, please visit www.tradestation.com/important-information. For those that are new to our options education series, I just want to highlight that we have multiple articles and multiple webinars on multiple option strategies. So I want everyone to explore the Options Education Center right here on the TradeStation website. It's easy to access it. You just have to go to Learn, the Learn menu right here on TradeStation.com, and click on Options Education. The very first section you see here are going to be articles that are well written, explaining each one of the option strategies. And what matters most, it also tells you, how to apply those strategies using the TradeStation's technology. On the second section, we have webinars. So similar to this one, which you're attending at the moment, we have had a series of webinars on the option strategies that I want you to come here and explore those as well. Okay. Here, let's see, let me go back here to my PowerPoint. Okay, this is time to pass the microphone over to Brandon. Brandon, it's great to have you again. How are you doing today?
Thank you. I'm doing great. Hopefully everyone is doing well here as well, and you are too.
Great. So I'm just gonna, mute my microphone, turn my camera off, and pass the floor over to Brandon. Brandon, it's all yours.
All right. Let me go ahead and share my desktop here. Let's see, we're good. Okay. Well, thank you, everyone. Thank you, Jesus and TradeStation, for inviting me. As Jesus mentioned, I'm not affiliated with TradeStation. I'm a trader and been instructing trading, worked in the professional field for quite a while. And they asked me to come in, kind of explain a little bit about the bear call spreads. So that's what I'm going to do. If you have questions, if you wouldn't mind, you can type them in the chat, but I'm going to answer questions at the end. We're going to try to stay on topic for once. But no, I want to make sure that I relay all the important information to you regarding the bear call spreads, and that you get as much out of this as you possibly can. So we'll do questions and answers at the end of the session. If we don't get to those for whatever reason, you can always email TradeStation. I believe the email address will be in the chat in a little bit. I think it's education@tradestation.com. But you'll see in just a moment. They'll put that up there for you. But anyway, what we should expect from today is quite a few things. There we go. Yeah, the email. Basically, we're going to talk about the fundamentals of bear call spreads. And there are definitely risks that are involved with this type of spread, because it is a credit spread, which you will find that the risk can be greater than the potential reward. So we got to make sure that we're properly utilizing, try to say two words at once, properly utilizing this particular strategy when it is appropriate. So we need to know all the fundamentals about it, how it works, and what the risks are, the benefits of it. We're going to go beyond directional trading, which is something that most people are used to, either buying a security because they expect it to go up or selling a security because they expect it to decline in price. Well, with options, we actually have an additional dimension that we can look at, and that's volatility and time. And that's what we're going to look at when it comes to this particular strategy. And actually, the one we did previous, which was the bull put spread, was very similar to that. It was kind of the other piece of it. And we're going to talk a little bit about TradeStation and how we can use the tools predominantly in the scanner and or radar screen to help find opportunities. We need to find an underlying security that we can trade to be able to utilize this strategy. So the nice thing is there's a lot of tools. I'll share with you how those work. And we're going to go into OptionStation Pro, which has even more tools that allow you to take advantage of the strategy as well, and to examine it to make sure it's the proper strategy, proper timing, proper security for that strategy. So what is a bear call spread? Well, most people think of calls as something that you buy when you expect prices to go up. However, we're going to be doing what's called a multi-leg credit spread. Multi-leg meaning more than one option. Credit meaning we're taking in premium. You still have to put out a margin deposit though, because there is risk, and that margin basically hedges the broker in a way. When you have losses, they come out of that margin because they are giving you leverage, the ability to trade more than the value that you're putting up as a deposit. So the spread being the multi-legs. So we're going to sell a call and collect premium. And we're usually looking to sell at the money or out of the money calls. Selling an in the money call may provide a little bit more premium, but it really increases the risk of an early exercise or early assignment. When you sell an option, you always have that risk of assignment, which means that if somebody wants that stock, they will call it from you because they bought the call. You are obligated to deliver it, whether or not you have the stock. So if you don't own the stock, you'd have to go and buy it at whatever price it is and sell it. If you do own the stock, well, you sell it at the strike price. So to protect ourselves and limit the risk of selling a call naked, at the same time, we're going to buy a call. Now, when you buy a call, you're going to be paying a premium. So that's going to reduce the amount of premium you collected from the sale of the first call. So we're going to combine those two risk profiles. You'll see that selling a call pretty much has unlimited risk. And that's not a good strategy necessarily. So when we combine them, and by the way, both options, the long call and the short call, share the same strike price. I'm sorry, not the same strike price, the same expiration date. Okay, they're definitely not the same strikes. I apologize. That needs to be fixed on that. It is the same expiration date. Why won't it let me get to that? It's the same security and same expiration date. So again, selling a call, buying a call, same expiration date, combining them together, there's your risk profile. Bear call spread is what it'll look like. As you can see, with the risk profile, it has a flat top, meaning you have limited profit, but it also has a flat bottom tail, which means limited risk. So that's what we're doing. We're limiting the risk. And of course, when you limit risk and reward always go together. You can't have one without the other. If you try to increase your reward, you will always increase your risk. If you try to decrease risk, subsequently, you will decrease your potential profits and rewards. So based on the underlying movement, the way it'll work, again, when you short a call option, the loss is potentially unlimited because prices of securities can go up. There's no top cap, if you will. They can keep going up forever. Oops, I went a little too fast. The premium collected when you sell an option is the maximum profit, period. And on the other side, sorry, I was trying to check something on my other screen here. On the other side there, when you go long a call option, you obviously have potentially unlimited profit potential because the price can go up forever. Not realistically, but it could, theoretically. But you're limited with the loss to the premium you paid for the option you purchase. So we're going to combine those and change the risk and reward. And basically what happens here is, again, we're going to sell a call, collect premium. Our intention is that the prices of the underlying security will stay below the strike of the call that we sold, period. And then we're going to buy that higher strike call and pay a premium. The max risk is limited to the difference between the two strikes. If you happen to be assigned on the short call, you could exercise your long call to limit that risk. And the premium you took in also cushions the risk a bit as well. So the maximum risk on a bear call spread is the difference between the strikes minus any premium you collected. Now, keep in mind, all options, most of you may know this if you're trading already, but most options are based on 100 shares. So whatever prices you see, you'd multiply that by 100 for the actual risk or reward. As an example, if I go out to OptionStation Pro, I'll look at a chain here. And if I decide I want to sell, let's see, we're currently trading at 102. I'll sell 105 and buy 106. So the difference between those two is only $1. I am collecting premium of showing 25 cents. That's the mid price. It's not actually what I'd probably get. But the difference between those two is $1 minus the premium. My max loss would be 75 cents or $75, as I mentioned. Pretty simple there. The nice thing is with OptionStation Pro, you get a lot of that information before you even place the trade. I know where I'm going in, what price I would mostly receive, and how much premium profit I would get, and how much loss is the maximum. And we'll learn that you don't always have to take the maximum loss either. Now, the break-even price is where the position begins to lose money. Initially, it's at maximum profit when you collect the premium, and it can only go down from there. It only gets worse. Well, not necessarily. If the prices stay below the short call strike, you get to keep the premium if the options expire out of the money, meaning the underlying price stays below the short call strike. But if prices were to start moving up, it starts to erode your profits once you reach the break even, meaning you don't win, you don't lose, you're at break even because your loss would be equal to the premium you collected. Once the price exceeds that to the upside, you start losing all the way up to the maximum loss. So in this case, the break even for a bear call spread is simply the short call strike plus the premium received. So in this case, it looks like we sold a $55 strike for the short call, and our break even is $56.20. So that means that we'd had $1.20 premium collected. You can figure that out from there. And if we wanted to figure our maximum risk, looks like the strike that we bought was 60. So it's a $5 spread. The difference between the strikes, 55 and 60, minus the $1.20 premium would be $3.80 maximum risk. So you can figure that all out from right there. Or again, if you go to OptionStation Pro, when I load in an option trade, in this case, it says vertical spread. I'm collecting premium, so I know that it is a credit. And if I hit analyze, I was looking at my chart and I realized it was a little off because the way I had the graph set. It's not a big deal. I wanted to put this at expiration to get the right data, and current, and 1. There we go. Okay, so again, you can see at expiration, maximum profit, $25, maximum loss, 75. And again, it says it all right here. And of course, there's what's called time value in between that changes my break even as well as the amount of gain I would have at any certain time. Okay. Basically, when we have the expiration, there is no time left. So the only value you can get from the option would be what's called intrinsic value, how much the option is in the money or out of the money at that point. We want it to be 100% out of the money, meaning it's below the strike price that we sold, in this case at $105. At expiration, we get to keep the premium. And you can see that the break-even price, well, I just adjust it this way, actually. Yeah, I'll get rid of some of these. Got too many. So if I want to know my break-even price, it's easy. As I said before, it's the short strike, 105, plus the premium. But if I wanted to see it on the chart, drag this over. And well, let me get there. Not quite. There it is. 105.25. I have 0 P&L. The value is 25. On the negative side, since I collected 25 profit, that's my break even. If I want to know what the break even is currently, remember there's time value, it's going to be a different price. And looking there, now I see my break even is actually, wrong way, roughly 102.27, which is actually below where I sold that strike. Why? Again, there's time value attached right now. So what we're doing is kind of demonstrating we're actually trading time decay, because as that time decays, the value of those options decline as well. So we'll get into that a little bit in the future here. Anyway, as I mentioned, one of the biggest problems potentially, or I should say biggest risk, is that you get assigned. Assignment means that whoever sold you that, I'm sorry, you sold, whoever bought that short strike call from you decides they actually want to exercise and they want the stock. You would have to give them the stock, or if you don't have it, you have to buy it at market value and turn it over to them. Now, one way of possibly avoiding or working around that would be to trade what are called European style options. There's two styles of options. We have American style and we have European style. With the American style options, do I have that on slide? Not yet. Okay. With the American style options, most stocks are American style options. Most ETFs are American style. That means that you can exercise whenever you want, even if the option is out of the money. I know it sounds weird, but sometimes it happens. I've actually had it happen to me where an option was out of the money. I sold it, but it was still exercised and I was assigned. You just have to deal with it. But a way of, I guess, avoiding or minimizing that risk, excuse me, would be to trade what are called European style options. European style options cannot be exercised until expiration. And those are typically index options. So if I go back to my option chain once again, and I'll type in $, that's an index. And actually the first one is the one I want, SPXW.X. That's fine. Doesn't like my chart stuff. I can't load up on certain things there. Actually, for that, let me turn this off, because I have this link. That's the other neat thing. When I'm doing analysis, I can link to my other pages that I have going on for analysis and whatnot, and it automatically reloads the option chains as well as charts. It's pretty neat. I'll show you that. But anyway, if I'm looking at, let's say we're doing 0 DTE, those expire today. See, 0 days till expiration. These cannot be exercised even if they're in the money until the close and they're settled. So if they're in the money at the settlement, the closing price, then they will be exercised automatically by the exchange. The Options Clearing Corporation handles that, and you'll get notified. Where does one trade European? No, it's the same platform. Like I said, pretty much the indexes are European style, but verify that by checking with the brokerage or checking with the exchange. They'll usually show which ones are European style, but for the most part, it's indexes. So if I look at different indexes, and of course I can look up, but again, type in $, I can look up securities here. There's also the lookup feature as well. But basically, if it's optionable, that's the other thing. And we'll go to Dow. Most of the index options are European style. So we have weekly, not every single day here, but we do have weekly. If I go to next Friday, those options are for the index and they should be European style. Okay. I'm not sure if there's a notification on the platform for that as well. Jesus would know better than I am, but I do, but I'm not familiar if there is. Like I said, the easiest way to find European versus American style, I know that most index options are, and if you check on the CBOE website, they'll tell you as well. So why use this bear call spread? Let's see. Yeah, question about the assignment. Okay, would the broker offset the long call? Not necessarily. You would actually have to notify them to exercise the long call. That's a great question. If you're assigned on the short call, remember your risk is limited only if you exercise the long call, right? If you don't exercise that, you might have to go out and buy the stock. No, you would have to notify them, especially, let's say this closed at $58. Well, the short call is in the money, would be assigned most likely, but the 60 call is not in the money. You would have to notify the brokerage that you want to exercise that to offset your loss. Again, verify with your broker to make sure what that process is, because I'm not sure for each brokerage, it may be a little different. You might get automatically, you may not. Most likely it would not be automatic because it's out of the money. Now, if this settled or expired with the underlying being above $60, both are in the money and it would be automatic. So then your maximum loss would be achieved. So why use this bear call spread? They have higher probabilities. We may have smaller profits than a debit spread, but there's higher probabilities. When you think about it, A debit spread needs prices to move in a certain direction for them to profit. And they have to move far enough and fast enough because you have time decay and you need that delta to make your premiums go up so you can sell at a higher price. You have to go beyond your break even. With a credit spread, like a bear call spread or a bull put spread as well, you don't need that price movement. You could have the price stay exactly where it is as long as it's below your short call option until expiration. So you profit if prices move down, you profit if they move sideways, nowhere basically, and you'll even profit if they move up as long as they do not go beyond your short call strike. So you have higher probabilities, 3 different ways, down, up, sideways, versus only one direction with the debit spread or even buying a put, right? You need prices to drop far enough and fast enough. So again, looking at this strategy, we have limited risk, which is nice. Obviously, if you try to sell a call naked, you have to have the highest level of options clearance or trading experience. So that's level 5 with most brokers. And if you don't have that, you have to do a spread to limit your risk. It's also smart to limit your risk if you can. Okay. Well, the bull put spread is what we did before. Bull put spread is a bullish strategy where you're selling puts. This is the bear call spread for the bearish side where you're selling calls. So 2 different strategies, but both credit spreads. Yes. So the alternative, if you're bearish, let's get back to that. If you were thinking that the market was going to go either slightly down or sideways, you could either buy a put or do a bear put spread, which is a debit spread, or use this bear call spread. And we'll talk about the differences in a few moments. And one of the biggest differences is lower cost. You're collecting premium. You have higher probability of winning because you have 3 different ways of profiting potentially versus only one if you take a directional trade. And the margin requirement might be lower as well. So that's pretty good, especially versus shorting stock. It'll be much, much cheaper. We'll talk about stop losses as well. And that's the nice thing about TradeStation. We have activation rules. We can set stops. So again, you don't have to be as accurate with your forecast. So if prices don't move exactly down to a demand zone or down to support, they only move a little bit, you're still okay. You can still potentially profit here using the bear call spread. Okay. So the risks, I kind of mentioned a bunch of them already. One of them is your reward is much smaller than the potential maximum loss. The most you can make is the premium taken in. The most you can lose is the difference in strikes minus the premium. So in this case, I was right. It was $1.20. So we had sold the 55, bought the 60, $120 of profit or $1.20 per share. Break even, 56.20. Again, the short strike plus the premium. And the difference of $5 between those 2 strikes minus the premium is $3.80 or $380 of risk. So it seems face value is like, why would you want to take all that risk versus that smaller reward? Well, 2 things. 1, higher probability. And number 2, you can set a stop loss. And I'll show you how to do that. Early assignment is also a risk. As I mentioned before, you could get that early assignment. You might have to contact the broker to make sure that they exercise your long option, your long call, to cover that. And if the prices rally a lot, if there's lots of news or movement, obviously you could go in the money in those options. We don't want that, and you get your maximum risk. So those are some of the risks that are involved. Other risks could be simple as you're not familiar enough with this strategy and deployed in the wrong environment, or you're not familiar with the platform and you put in the wrong trade, you put in the wrong numbers, whatever it may be. Practice. The nice thing about TradeStation, you have simulated mode. You can practice as much as you want in a real market environment without the risk of real dollars. So that's kind of nice. Now, let's talk about time value. I mentioned that you can actually look at trading time and volatility. So with a credit spread, any credit spread, you're actually expecting time to pass with the options expiring out of the money, meaning that in this case, the call that we sold, prices remain below that for the underlying. So we have what's called theta. If you're not familiar with the Greeks, definitely get familiar with those. Theta, T for time, is a measure of how time affects the premiums on options. So it's time decay. Basically, I equate it to an ice cube. You take an ice cube out of the freezer, it starts melting. You buy an option, time is melting that value, right? Well, by the way, if you have a large chunk of ice, it melts slower than a small sliver, right? So larger time left will melt slower than smaller time left. You got to keep that in mind as well. Let's see. No, Richard, I mentioned that earlier. If you go in the money for the short call, but not the long, you can decide to exercise that long call to minimize the risk. But if it's not necessary, then you can just take a small risk or, again, buy the stock at market value, sell it, and have whatever loss you have minus the premium. So getting back to the time decay here, theta, you'll notice we have positive theta. When you see the theta of a position is positive, it means you benefit from time decay. Okay. If you see a negative, like we see here in Vega or Delta, you want that to go down. So if we had negative theta, we'd want time to, well, stay where it is. It won't happen, but as time decays, you lose. Positive theta, we make a profit as time decays. So time decay will lower the premium. And if you need to buy back this position, which you could, if the prices drop and the premiums drop, you could buy back the option you sold and sell the one that you bought, potentially for a profit. You know, if you buy back for less than you sold it, that's your profit. Time decay is not exponential, or it's not linear. Sorry, it's not linear. It doesn't go in a straight line down as time decays. It's more of a curve. You know, if I take a look again at these options and focus on the theta column here, you can see that this is 7 days left till expiration. We have a theta of -21 on the calls. But if I go further in time, come on, there we go. We only have 7 cents. So remember, that bigger ice cube melts slower, and the smaller ice cube, here's a little sliver that's expiring today, theta is over $1. Okay, again, that is per share. So that is dollars and cents. Yes, that is how much the premium should decay for every 1 day that passes. So in the case of this option, by the end of the day, the time decay should drop the premium by $1.39 per share, $139 for the entire position. Next part is actually one of the biggest pieces. And this is part of why you would choose the bear call spread versus a put spread, or even buying a put. It's volatility. Volatility has one of the biggest influences on the what they call time value. I know it says time value. It's weird, right? Time value is not just time. It's time and volatility and a bunch of other things. Okay. So you've got the intrinsic value and the time value, but the biggest impact typically on options premiums is volatility. And Vega measures how much the premium will change up or down based on a 1% change in volatility. So if you have less than 1% or more, you know, if they're not whole numbers, you just multiply. That's all. But anyway, with volatility, again, volatility is one of the biggest impacts on the options premium. We profit from a drop in volatility. Notice right here, we have 0 change in volatility, and theoretical value is pretty close to where we were selling. But if the volatility drops, price didn't change. I didn't change the current price of the underlying. I kept it at $50.87. But look what happened. The value changed and the profit went up by $5 with a 5% change in volatility. If we go a little further, 10% change in volatility. Look what happened. Doubled our profit from $5 to a little over 10. And again, nothing else has changed on the price, pretty much staying the same. 15% change in volatility, same price, now a profit of 18 cents. And the volatility actually increases as we're making profits as well. So it's helping us out further and further. So since we have a negative number for volatility, Vega, that means if volatility drops, we profit. If volatility rises, though, we start to lose. So going back to my example that I have under my analysis page here, I still have it. Oh, there it is. Oh, I deleted it, didn't I? Hang on. Let me see. Oh, that's because I changed securities. So it was a trade on Abbott. So let me go back over to, I could create one on this, but I already have that one. So here it is. And you can see that current price And we'll go, well, let's keep now for the time, 102.27. Actually, that's not current price, but that's okay. I'll keep it there. If I change the volatility to -5, not 50, look what happened. Prices didn't move. Time didn't change. Volatility changed, and we made a $7 profit. Now, if volatility goes up by 5%, we get a loss. If it keeps going up, it'll adjust and our losses grow because we want volatility to drop to lower prices. Remember, we sold something expensive. We want it to drop in value so we can potentially buy it back cheaper or let it expire worthless. That way we keep 100% of the premium. So bear call spreads are best entered if volatility is really high. Now think about that. If we wanted to buy puts, we would actually, if volatility is really high on that security, we'd be overpaying for the puts. Now, could they get more expensive? Yes. But if volatility is currently very high, prices and the markets in general are mean reverting. They go back to averages. So if volatility is currently very, very high and is likely to come down, if you buy a put, that's likely to drop in value, and it may drop in value even more than what you profit from the price moving. That's where the bear call spread may be more advantageous because that drop in volatility helps that. When you do a credit spread, it hurts if you did the bear put spread, bear put spread or bought a put. Okay, so that's one of the reasons why you'd want to choose one or the other. If you expect volatility to drop and you expect prices to either drop or stay somewhat the same, that may work. Selling the calls. I keep getting confused there. Sorry. Selling the calls is better. What's the favorite setup I want? Well, there's not necessarily a set number that I want. So here's the question kind of leading into that. Thank you. What should we look for? What do we want? Well, we want relatively high volatility. And unfortunately, there's not a set exact number. I can't say, oh, it's 38.52%. No. Okay. It is looking back at the history of the chart. You look to see what is volatility now compared to what it's been. And there's two types of volatility. We have implied volatility, which is what we're expecting for price movement in the future. And that's kind of what volatility is. Volatility tells you what the future holds for the price movement. Is it going to go up fast or down fast? When you look at TradeStation, OptionStation Pro, it's kind of cool right here. There's the implied volatility for each of those options for that security based on when they expire. And not only do they tell you the implied volatility, but notice this is plus or minus 105. That means in the next day, that security Abbott, because it's got 22.86% volatility, will likely move up or down from where it is right now by $1.05. Now, could it go beyond that? Yeah, of course. Could it go less? Yeah. But right now, based on current volatility, and that's measure of where prices are expected to move roughly 30 days in the future. So we're not going to move up by 23% or down. Again, we're only moving maybe $1.05, $1.04. You see it adjusts. Okay. But what we're going to look for is relatively high volatility expected to return down to an average. And with TradeStation, I actually look at the charts. So we have implied volatility, which is looking forward, versus historical or statistical volatility. Historic or statistical volatility is what volatility has been in the past. Honestly, it's just your chart, if you think about it. Implied volatility is what's expected in the future. So we have relatively high volatility. We're expecting it to go down. So the current implied volatility is above the average. It should revert back to the average. Doesn't guarantee. If you have a high implied volatility versus historic volatility ratio, meaning we're extremely high versus where we've been in the past, that might help as well. And there are technical indicators. And of course, this is a bear call spread. We expect prices to be declining, but not necessarily extremely fast or very far, because the farther and faster prices drop, volatility will go up. So we want kind of a gradual decline or somewhat sideways movement in price. So again, if I go out to my charts, which I have, wrong page. There we go. So these are two indicators that are already built into TradeStation. Everybody has them if you have the platform and the brokerage account. So implied volatility divided by historic volatility, that's the ratio. And then here, implied volatility for all options and it's plotted against its average. I kept the defaults. The only thing I did was thicken the line so we could actually see them. And for the most part, we're going to want to see both high implied volatility versus historic, and it's above the average. As you can see, it's using this 140 and 85 for the cutoffs. And you could possibly adjust those, the high and low numbers, if you're noticing that it's not really catching the good peaks, if you will. But notice what happens when we go above that high. Actually, let's go a little bit bigger here. There we go. Much better. I want to be able to see this. It doesn't matter what price does. Although, again, we profit from sideways to downward price movement. You can see their implied volatility was very high versus historic, right? And what happened? Eventually, it dropped. Same thing here. Came down, went up, and then came down again. Also, at the same time, you can see that, again, this is implied volatility versus its average. If I double click, you'll see that the inputs, average length, that's the average of implied volatility versus the implied volatility of all of the options, calls and puts, all of them. So right here, what I'm looking for is kind of the best of the best, if you will. And let's do this with a hard right edge example. Kind of like that. Because it's easy looking back, right? And this is where you got to kind of look back and see what has been the average price movement or indicator movement above the alert area, or what is the average expansion here before it snaps back. Because if you sold right now thinking volatility is going to drop from this level because it's high above the alert side and it's high above the average of implied volatility, it might work. But what if it goes higher? Well, you might lose a little bit because of volatility there. So we see it actually did go a bit higher, right? That's the problem. That's why there's not a set number, and every security is a little different. Volatility at 128% is inside the normal range for the security, but that might be extreme on a different one. So volatility is different based on different securities, and we want to find kind of an average movement away to know what our alert should actually be. You could actually change those alerts as well to match that. So it finally did come down, but you had to take a little bit of pain first, and you see prices actually went up. So your options may have gone in the money, which is why not only do you need that high volatility that's likely to drop, but you also need prices to move either sideways or slightly downwards. So we want to look for a strong resistance or supply zone, and maybe a security that's in a downtrend, pausing before it might drop some more, but not really drop fast, right? You don't want that volatility going up. So no, we definitely do not eyeball. We are going to use a scanner for this. As a matter of fact, if we're looking for high volatility, I showed you those two tools that you can use there for sure. But right here, we have the RadarScreen. So there's a RadarScreen, and in the, where is it here? If I go back to my browser, the Options Education Center, right here, you have all the different strategies. There's bear call spreads that we're talking about right now. If I click on Learn More, Jesus was kind enough to help you guys out, and you'll notice download workspace. This workspace right here, bear call spreads, is available for you to download with all of the studies the way we do that. So you can see I've got these indicators, not just the indicators. This is the S&P 500 populated in this list, and I'm filtering for liquid options, meaning they're above 10,000 contracts. Let me see, do I have this on? No, I don't. Sorry. I was trying to zoom in on this, but I don't have the tool on right now. My MACD is below the average, meaning that we're in a bearish trend. My RSI is below 60. That's also telling me we're in a bearish trend. This is on the daily chart. The implied volatility is above the average. And our percent change, and I have to check to see the timing on that one, is lower than 5%. I mean, you can play around with these as well if you wanted. We could also look for the implied volatility, historic volatility is above the alert. You could add that one in. So this is one way of scanning some of the securities to find. You see AVT is there. It has liquid options, 214,000 open interest. Volume is good. Implied volatility is above the average. And it is dropping and it's bearish. Okay. Let's see. Windows run OptionStation Pro. I'm not sure. Again, I don't know anything about the software. I don't work for TradeStation, so you have to ask them. But not only do we have this, but the other neat thing is with RadarScreen, you'll notice there's two other windows here. We have what are called hot lists in TradeStation, or I should say they have it. And with the hot list, you could actually create different lists based on an additional scan. So what I've done is I've included implied volatility is highest. This is scanning all those securities that are out there, finding the highest implied volatility, and then running the filter on it. So it's narrowed down quite a bit, obviously. And I don't know if I'd want to trade these. They're very small in price, even though they do have some liquid options. I'll take a look at this $6 stock AQN. And unfortunately, it's right near kind of some buying pressure and demand. So a bearish spread would not be a good idea. But yeah, I can scan more. We also have implied volatility breakout. These are a little bit higher price securities that might be better. And what's happening is the implied volatility has taken a huge jump upwards, and it may be well above the average. So let's take a look. SHY, that's an ETF, right? It looks like it's in a bit of a downtrend there. The weekly chart also looks like it is kind of sideways just below where it dropped from the 8160. So if I go over here to my chart with the implied volatilities, you can see, oh yes, it's jumped. It's above the average. And every time it's jumped like that, implied volatility has declined. So this might be a candidate for a bear call spread. So I would take a look to see a little bit more analysis. Where is this likely to stop moving up and start dropping? Yeah, not the great supply area here. Unfortunately, we do have the good volatility, but this may not be the best candidate. However, I'm going to look around this 8160, 8180, maybe 82. So if I go over to OptionStation Pro, SHY, now this is where you're going to have a little bit of a decision to make based on which options to trade. Do we want the higher theta? This doesn't look like it's good at all, actually. Pricing is kind of weird. Or do we want to have more premium? And that's a question that somebody came up with earlier. You know, if you go further out in time, you'll get more premium, but it won't decay as fast. I typically look for a sweet spot between 45 to 30 days till expiration. As soon as you hit that 30 days and less, the volatility really starts decaying quickly. So if we can get some premium right around 22 days is a little inside, that might be okay. And I said 82, well, there's no premium here. So that's not going to work. We got to find a different security. No big deal. Go back to our scanner. We have CNH. Now it's a $10 stock, definitely bearish. And at $11, there's definitely some selling pressure that came out of that area. Take a look at the volatility again. And it has spiked well above the average, not quite as high as it's been before, but it is possible. So we take a look at CNH and the options. Again, 22 days or 50 days are our selections. And again, the premiums are not very good. Well, I got to make money on these, so keep going. And just because it's got a jump in volatility doesn't mean it's going to be a great security. You see the open interest is still above 10,000, but not the highest. So if I go back to the S&P 500, I might be a little better off there. And if I'm looking for high implied volatility, I can also sort them by implied volatility. I think if I double click here, am I going to do it? Thought I could sort by implied volatility ranking, but I guess I don't know if my computer's just not doing it or what. But anyway, right here we got 40% on American Airlines. It's not too high above the average. Is that the highest so far? 40%. Again, the difference between the average and where we are currently is more important than the highest number. So right here, Salesforce, CRM, that had some movement, but it's got 44%, almost 45% versus 34% normal. And this has probably got a big gap down today, as you can see, both on the weekly and the daily. Well, obviously it's moving down. The volatility is going to be very, very high with that big move down. And you see it's dropped from that level before. It's a possibility, but we don't really have a good level to be able to sell right nearby. Again, if I go to CRM and look at the options, the pricing will be much better than what we were looking at before. And I have more choices. It's much more liquid. So I could go 36 days out, decent time decay. And I would just have to choose the right options for that, again, based on where I believe the prices will not go above. With the gap, I don't really have a great opportunity, but maybe this prior low area around 250. If I sold the 250, bought the, sorry, I got to delete the other ones I forgot. Take off the old ones, otherwise it's going to mix the two. So I hold down the control key, click 250 on the ask, then I click 255 on the bid, and there it is. There's the bear call spread. And right now, mid's 14. Not sure if I'd get that because you can see the pricing is a little awkward there because of what's happened today with the volatility jumping and the gap. Well, maybe I'm not ready to enter this right now. Maybe I want to get in this when prices come up towards that 250. I can do that with TradeStation right here. I can use activation rule and I can set up, you know what? I don't want to enter this until CRM has gone equal to or greater than, let's say, $245. And I can protect myself from bad or what they call late prints by making sure it trades inside of the best bid or offer as well. So this order will be stationary. I have to keep the computer on as well because it's housed on my computer, not the broker. But what I can do is set up this order with the activation rule that this will not trigger until prices move up to where I'm comfortable with the premium. And let's say, I don't know what the prices are going to be. Actually, you know what I could do as well before I even go there? Analyze what the prices might be when it gets to that level. So we change the volatility back to 0. This is so cool. We can do this. Let's say we're expecting to go up to 250 in about, well, let's see, based on the price movement, it might take a while. Let's say it's going to take a month. Well, I'm not going to use the July. I'll use the August options instead for that. Change both of those. 250. Oh, what happened there? I'm going to have to reset this. Hang on a sec. Delete position. Do this right. So if I don't want to get into this until prices get to that level, I can postpone the entry with the activation rule. It's pretty cool. So I clean this up. Excuse me. I'll make it easy. Let's say it's going to take maybe 20 days. So I'll use the 50 days until expiration. So again, 250 and 260. It's a little bit more risk because there's only $10 strikes, not 5. But again, activation rule, I can do the same. Do not place that order unless CRM goes into or above, let's say 245. By the way, there is a video on this, on what I'm doing right now called activation rules. If you go back to the Options Education Center, right here, and there it is, placing activation rules on options orders. There's a whole video on that for you and instructions, a whole bunch of stuff. Anyway, again, I want to make sure that 240 is the right price. I could set a limit order for that price based on where I think it's going to be, or I could just simply put in a market order. With the market order, I don't know what I'm going to get. So if I want to kind of guesstimate what it might be, I go here and change my graph to, let's see, 30 days till expiration. There we are. I'm looking over here and you see it changed to 30 days till expiration. And now plot 2. If prices get up to 240, that means the option should be about $2.15, roughly. Well, 215 is a lot better than what am I getting now? 64 cents. So it might be beneficial to wait. Okay. So I could use that as my limit order if I choose when I place my order. So 2.15 credit. Okay. Max profit should be 215. Max loss. And you can see if it does get to that 240 area, it's pretty much flat. It's not absolutely 0 because prices are moving a little bit, but I've guesstimated what the premium should be if prices get there. And this order will not go in until prices actually get there. Now, what if I have a position? This is another question that came up. I'm going to clear this. What if I have a position in, let's say we put in, this is not a good one. We go, actually do this. SPXW.X. That's the S&P 500 index. And you know what, I guess I can put it here. You know what? Actually, no, I'm going to do a different chart. You'll see why. I don't want all that volatility stuff there for right now. And let's say I'm looking at day trading the S&P 500 index with 0 DTE options. So if I want to do a bear call spread and volatility is high that I could possibly collect some premium, maybe, and that I'm not saying this is the level, okay, I'm just quickly doing analysis, so it's not complete. This is not a recommendation. I'm not telling you the right numbers necessarily, but let's say that I don't think that prices would get above 52.80, okay? Now, if they go above 52.80, I don't want to lose a ton of money either, even though I can only lose a certain amount on a bear call spread, right? So we have 52.80 on a 0 DTE. So here we are, options expiring today. 52.80 is 45 cents. And buy the 52.85. Get rid of the other CRM orders. And there we have a bear call spread and make $20, risking $480. Now, it doesn't really make sense to risk $480 in order to make 20 bucks, right? Well, what we can do is once this order is filled, and actually it's going to be worse because I'm just going to do the natural price and place order. See if it gets filled.
Order filled.
Order filled. Okay, so I got it now. For better or worse. Again, I'm not telling you to do this. I'm just trying to do an example. If I go over to manage, first of all, looking at that security, you know, I may want to get out of it if it breaks above today's high. Really, what I could do is analyze this by going to manage, find the trade. There it is. It's showing as separate orders right now, but I can combine them like this. There it is. Now it shows vertical spread. And let's see, analyze. I can either analyze the security or analyze close. Actually, I want to go back 1 second here. Put it back in and analyze it. So I sold the 80s, buying the 85s. There we go. Same as I did already, but analyze. And what I could do is figure out, maybe I'm willing to risk $60 to make 40. By using the price slices, I could figure out what price level would I be losing that $60. Now, it's not accurate 100%. It may be a little off, but if I adjust this, let's see, is this right? Yeah. Right here, theoretical P&L, and this is on today's. Zoom in a little more. Bring it over to where I start losing money. You can also adjust it with this plus and minus right here. And again, what I could do is figure out what price level would I be losing, let's say $60 approximately. So I keep adjusting this until my theoretical profit and loss is at 60 bucks. There it is. Negative 60 is at 52.80.75. So that's not maximum loss, right? I can only set this once I'm in the position, right? My maximum loss is $485, and I'm only making, I was saying $20 on the other actual position, right? Actually, we can do this. There it is, 20. That's better. So theoretically, I would lose 60 bucks if we go to 52.80.80. So what I could do is put in a stop loss. Watch how I do this. I go to my managed position, the one that's open, close this position. So I'm buying back the 85. Sorry, buying back the 80, selling the 85. That's right. With a market for my stop loss, but only do it if the SPX goes equal to or above 52.80.80. I can leave a single trade tick for the index if I choose, and that's it. If I place that order, Make sure. Max profit, max loss. Yes, that should be right. And it's set. It's not triggered. Basically, that will get exited if the prices go above that level that I determine should lose roughly 60 bucks. So that's my stop loss. And I could do the same thing for a target by when I go in, same thing. If I do this, see trade. Nope, I don't have it open anymore. So again, going back, instead of just doing the stop loss as I did under the open position, I do close this position with a market order activation rule. If prices either go above, there it is. I got to add it twice. So prices either go above 5280.80, or if they reach a target less than or equal to a target price. So let's say if it gets down to 5250, I want to get out. So you can do either or, and it'll be a target or a stop. How cool is that? So it's a market order. So I don't know exactly what price I'll get out at, but I know based on the slices and the analysis I did, approximately what I should get out at. Obviously, I'd have to make sure with the volatility and all that other good stuff to make sure it's more accurate. Okay. So if I'm setting a stop loss before the expiration, why worry about buying the option? Well, because if you do a naked call by selling that, your market or margin is going to be much, much higher. And if you're not a level 5 options trader, you could do this with level 3. So that way you can do that. You can't set the stop loss on a spread based on the premium. You can only do it based on the price movement of the underlying here. So that's why I do it that way. And as an OCO order, you can only do that on a single leg, not on multi-leg, unfortunately. But that may be in the works in the future. We'll see. So that's kind of what I wanted to go over with the bear call spreads. I kind of showed you how to find some of those. I found an example using the RadarScreen and filtering, and talked about the order placement, the analysis, and the stop losses. So I pretty much covered all that. Are there more questions that I didn't get to yet? Because we're pretty much almost out of time here. Maybe out of time, actually. And yeah, if you ended up with a 60 and 55, you wouldn't necessarily exercise the 60 unless you needed it to cover your losses. You know, your maximum risk, if it's less than that, because you could, you know, if you sold that 55.60 bear call spread and prices were at $58, you could buy a 58, sell at 55, you'd lose $3 minus the premium you collected, rather than exercising your out of the money call. Yeah. So you'd only exercise if you needed that. As far as option levels, again, if you go to the Education Center, where is it? You just got to scroll through them. There's a lot of different workshops here, and I'll be doing more in the future. Just keep an eye on the calendar. I thought there was one, there's something here somewhere. Ah, there it is. TradeStation options level. And you can click on that, learn more. Again, it's in the education area, for options education. And this will be posted on this part of the website, not necessarily YouTube, but it'll be posted up here after it gets a review and edited for the video. So we'll get this up as fast as possible for you guys. But yeah, you can see there's actually 5 levels. The bear call spreads fall in level 3, I believe. Yeah, they should be in level 3. It's also on the TradeStation website as well. But in the Options Education Center, we have more information about that, as well as the different strategies. You know, I was making mention of the bull put spread that I did that workshop on, and there it is. You can actually learn about both of those. And coming up next month, you're actually going to see, I think it's, I forget who's doing that one. It's one of the exchanges. Is it the CBOE? They're going to be doing something on iron condors and iron butterflies coming up. So
OIC.
Again, OIC. I'm sorry. Options. Yeah. OIC. So if you go out to TradeStation and the events tab, you'll see that under learn, and you'll get all the schedules there. So this is us right now and upcoming ones as well. There it is, Iron Condors with Jesus and Matt Cashman coming up June 12th. So not too far away. You'll learn about how to put those strategies together a little bit more. So yes, it is in the Options Education Center. I'm going to go ahead and turn this over to Jesus. I guess he's got a poll for you guys.
I sure do. And I just launched it. You should be able to see that poll on the screen. And Brandon, that was some great information you shared with us here. So thank you for using this time and helping us out. The poll is just a short 5-question poll. So it takes time to answer. It'll really help us, define some of the additional topics that we want to do going.
I think your audio cut out. I don't know if you're still there.
Through the editing process and compliance, the regular stuff. But we'll have it posted on the TradeStation YouTube channel and also on the Options Education Center, as he pointed out. Did you have any other last comments, Brandon, or are you?
Actually, there was one more question from Edward. When I do my 0DT
Yes.
SPX trade, do I watch volatility and the average as well? Not necessarily. I look at, that's more of a directional play based on supply and demand, where I think prices will not go. And I try to capture a minimum of a certain amount of premium. So there are different rules for that. And I share those rules with my students. Yeah. So, but I want to thank everybody for being here. Hopefully you gain some more education and insight. Again, practice in a simulated mode. It's really easy to log into that and play around with those bear call spreads, bull put spreads, whatever it may be. And the Options Education Center is growing with a lot more information. Just keep checking in on that, and there'll be a lot of good stuff there for you coming up. So again, thank you, Jesus, for having me.
Thank you, Brandon. And Brandon is a recurring guest, so check out our schedule of events, and I'm sure we'll have plenty of presentations from him down the road. Thank you, Brandon, for your time. Thank you, everyone, for joining our webinar today. Please take some time to finish the poll, and I look forward to seeing you in one of our future events. Thank you for joining us today.